Hi, you guys. Welcome back to the channel. My name is Brad. This is the Firefighter's Financial Toolbox. Today, I want to discuss the differences and pros and cons between investing in index funds and dividend investing. Now, both have their high points, both have their pros, both have their cons, and I do a little of both. But I found this article on Seeking Alpha, and I thought we'd go through it real quick and talk about some of the points on it. It says, dividend investing advocates will tell you dividend investing is the best way to invest. Index investing advocates will tell you that index investing is the best way to invest. Both have compelling arguments. I am in a unique situation. I run a dividend investing newsletter. Obviously, I prefer dividend investing. But that doesn't mean dividend investing is right for everyone. And I'm not nearly as dogmatic on the subject as my work might indicate. Many people who read the Sure Dividend were longtime index investors who switched over to dividend investing. Other readers leave Sure Dividend to go follow an index investing strategy. This article is going to compare index investing and dividend investing, and it will help you determine which strategy is right for you. The crutch because of the trade-off. Dividend investing can be very cost effective. In a large portfolio, it can be cheaper than index investing because there are no management fees at all if you're a buy and hold investor. And as I always say, you guys, buy and holding is the best investing strategy, always. The trade-off between investing in individual stocks, or dividend stocks in this case, versus funds is the trade-off between focus and diversification. Index investing by nature gives investors cheap access to massive amounts of diversification. Investors who select individual stocks eschew diversification in favor of concentrating on their best ideas, which means you're picking stocks you believe in that pay a dividend. Okay. Investors who select, for some people, this will result in poor results. For investors better than average, it will result in better than average results. For index investors questioning whether it's possible to outperform the market, I recommend reading Super Investors of Graham and Doddsville. This isn't to say it's easy to find favorable investments, but it isn't impossible either. It does take a lot of time, however. There's compelling evidence that simple algorithms perform better than experts. I'm not sure I agree with all of that, but let's keep reading. With that said, index investing has one big advantage over dividend investing outside of the focus diversification trade-off. Index investing's biggest advantage, if you're not interested in learning a great deal about the market, then index investing is right for you. So let me repeat that, you guys. So if you aren't one of these people that wants to study charts, learn PE ratios, understand all the things involved in picking individual stocks, index investing is easy. You set it and forget it. This sounds almost derogatory, but it isn't meant to. Some people are passionate about businesses and investing. Some aren't. Don't pretend to be if you're not. In other words, if you don't really want to learn about all this stuff, you don't have to. The biggest advantage to index investing is its simplicity. It takes it very little time to implement an index strategy and very little research. Warren Buffett has chimed on his advice for an index fund strategy. Buffett's index investing plan is simple. 90% into a low-cost S&P 500 fund. For example, the Spider S&P 500 index, that's ticker symbol SPY. And then 10% in a short-term government bond fund. And he gives the iShares 1 to 3 year Treasury bond index, which is ticker SHY. And then set it and forget it. That's all. Now, I will say I am in favor of some international in there too, and that doesn't have it, but everybody to each their own, right? While not explicitly stated, I assume the portfolio would be rebalanced occasionally, maybe annually. This portfolio would have an annual expense ratio of 0.10%. So on $1 million investment, it would cost you $960 in fees a year, you guys. That's super, super cheap. You can put a tremendous amount of time and research into picking the perfect index investing strategy, but there's no need to. And that's the biggest advantage of index investing. It is by far the most time-effective investment strategy. Who is index investing right for? If you're looking for average returns and minimum amount of work, index is perfect. I put average in quotes because average is not really average. Most individual investors significantly underperform the market. That's not an opinion, it's a fact. Investing in an all-world fund like Vanguard's Total World Stock ETF, ticker symbol VT, which has an expense ratio of just over 0.16 a year, may not sound exciting, but it will likely cause you to have much higher returns than most of your friends, despite what they may tell you about their latest, greatest investment. Additionally, it takes a tremendous amount of patience and determination to invest in individual stocks. People thinking they're going to make a quick buck by using the superior intellects to crush the market are going to do anything but that. If you think you're going to pull 30, 50, or even 100% year returns by selecting the best stocks, stop now and save yourself a lot of money. Just become an index investor. Your investment account will thank you. There are people on the internet who will say anything to play the false belief that you can double your money quickly with fraudulent investment schemes. You guys look out for those, okay? So now let's take a look at the advantages of dividend investing. Okay, so the author, I am a dividend investor. I didn't fall on my head one day and decide to only invest in dividend stocks. There is compelling evidence as to why dividend investing in general and dividend growth investing in particular works. The first reason to invest in dividend is particularly high quality dividend growth stocks is they have a history of excellent performance. The image below shows the performance of various types of dividend investing versus non-dividend paying stocks from 1974 through 2014. And you can see that they're above 9%, you guys, somewhere in the 10%. And then you have some dividend payers that are non-dividend payers down here. And the ones that have cut have performed a lot less. Take a look at a historic performance of dividend aristocrats below. Now, a dividend aristocrat is a stock that's been paying and increasing its dividend for 25 years or more, you guys. So if we look at what the S&P 500 has done, and it's definitely gone up. If we look at the S&P dividend aristocrats, they've actually outperformed that pretty well. And if we look at the total returns over, let's look at the 10-year. We're at 10.81% for the dividend aristocrats, where the total benchmark is about 7.42. So they've definitely done better. Now, you could invest in a dividend aristocrats ETF. That's the ticker symbol NOBL. That's the ProShares Dividend Aristocrat ETF. And I have talked about that in previous episodes. But it does have a little bit higher expense ratio, you guys, of 0.35%. But you could also buy the individual stocks in that. All right, one of the advantages of investing in individual stocks in general over ETFs is you have much greater control over your investments. If you're retired, as an example, you might require a portfolio that yields over 3%. You might also prefer low volatility. Low price to earnings ratio businesses with long dividend histories can fill that bill. In short, buying individual companies allows an investor to tailor their investment accounts to their exact needs and preferences. So let's do a little comparison between index investing and dividend investing. Time, cost, returns, and psychology and risk. Investing in index is clear winner when it comes to time it takes to invest. Index investors need not keep up with individual stocks. Dividend investors should periodically check in with the companies and businesses in which they've invested to make sure the company still has a strong and durable competitive edge. In other words, you got to keep up with your investments. Index investing, you buy the index, you let it go. Cost. Cost is not as clear cut. For long-term buy and hold investors, dividend investing is likely cheaper because you're not paying an annual expense ratio. Once you buy the stock, as long as you own them, you own them. You've bought it. Now, dividends are taxed, but many funds pay dividends as well. What does that mean, you guys? When you get your dividend from a stock, if you've held it long-term, remember, those are taxed at long-term capital gains rates, so you get a lower rate. But also, index funds, many index funds pay a dividend quarterly, And the same rules apply to those, you guys. If you've held them for over 120 days, then they're long-term gains as well. So if you're holding them in a taxable account, that is, okay. If you're holding them in a tax advantaged account, it's not going to make a difference. Now here's some of the math behind an investing funds versus dividend stocks. $100,000 on a low-cost Buffett fund, for example, SPY, would cost you $96 a year. Meanwhile, 100,000 invested in 30 dividend stocks at $7 per buy is $210. Now, remember, most of your low-cost investment houses now don't charge you to buy stocks. So this may be a little bit outdated, but something to think about. After 3 years, the buy and hold investor will have paid less fees. A buy and hold investor will pay far less in fees over their investing lifetime. All right, so let's look at returns. I've cited return data for dividend investing in other places. Investing in individual dividend stocks with lower than market return averages, higher than market return average, and strong competitive advantages will likely result in solid long-term returns. When I say solid, I mean there's a good chance total returns will be a few percentage points above the overall market. Investors should not expect 30% a year returns for anything of that nature. Now, with index investors can invest in value or dividend funds as well, and the more these funds try to take advantage of a specific factor that have historically resulted in greater long-term returns, the more they tend to charge. So, if you're looking for a plain vanilla S&P 500, it's low cost. But if you want a Dividend Aristocrat ETF, for example, you're going to pay more every year for that fee and expense ratio. Psychology and risk. I much prefer to know what businesses I invest in. When recessions hit, it's easier for me to know that PepsiCo and its underlying businesses isn't going to suffer too much no matter what happens to their share price. People are going to keep drinking Gatorade and buying Lay's potato chips no matter what happens. In my experience, when you are familiar with business and understand that you have fractional ownership in that business, it's easier to hold it during recessions. Dividend investors also typically watch dividend payments instead of the share price. Now, we've talked about this in the past as well, you guys. When I'm looking at my dividend stocks, as long as my dividend isn't being cut, I'm not as worried about the day-to-day share price and what it does. Case in point, ExxonMobil, this is one I own, you guys, ticker symbol XOM, has seen a huge share price drop in the mid-90s into the high 50s during the Great Recession. And as you've seen this year, it's still gone. Oil stocks have taken a bath, but it's still paying a dividend. And because the share price is up, my actual dividend yield has gone up. Now, as long as they aren't cutting the dividend, I'm not going to sell that stock. And that's something to think about. On the other hand, index investing has its perks as well. A highly diversified portfolio can be easier for investors to hold depending on your mentality. In other words, if you have faith in the stock market, you have diversity in your plan, you have maybe a lot more psychological reasons to keep holding that investment. All right, final thoughts. Dividend investing and index investing aren't really at odds with each other. They both work well for different types of investors. Having an investment plan and sticking with it is far more important than agonizing over dividend investing or index investing. Both strategies can work well. Some people will be more suited to index investing, while others are more suited to dividend investing. What you value will determine which is a better choice for you. Investors preferring to minimize time analyzing financials, index investing is going to be for you. If you're more hands-on and you want to spend a little more time learning about the businesses, then individual stocks and dividend investing is probably better. You guys, I have a hybrid. I started as an index investor only, and I would say that 90% of my portfolio is indexes. That being said, I also hold about 20 individual stocks, and each of them are companies that I totally have looked into and I researched. They're also companies that I understand. They're something that if I can't explain the company and what they do to a 10-year-old in 2 minutes, then I don't hold it. Which is better for you? Let me know in the comments, you guys. Are you a dividend investor only? Are you an index investor only? Are you a hybrid like I am? Let me know in the comments. Anyway, I hope you got something out of this. If you did, you guys, do me a favor, drop me a like. If you're not already subscribed, subscribe to the channel. All right, we'll see ya.